On 11 November 2022, a junior investigator at the U.S. Attorney's Office in Manhattan scrolls through a balance sheet that does not make sense. He is sitting in a windowless conference room on the 9th floor, fluorescent lights humming overhead, a legal pad open with 3 numbers circled in blue ink. The sheet in front of him lists billions of dollars in customer assets that appear to exist only as internal tokens and promises. On the opposite wall, a muted television shows footage of a smiling founder in a grey t-shirt waving to a conference audience. The investigator underlines one phrase in the document: intercompany loan. This is the starting point of a collapse that will erase tens of billions on paper and trigger one of the largest financial investigations of the last decade. This is the story of how authorities built the Manhunt behind a billion-dollar crypto exchange collapse.
2 years earlier, the exchange looks untouchable. It is valued at more than $30 billion, backed by venture capital firms and promoted by celebrities and athletes. Its founder is presented as a new kind of billionaire, frugal, altruistic, promising to give away most of his wealth. The platform advertises low fees, deep liquidity, and sophisticated products aimed at hedge funds and retail traders alike. For many users, it becomes the default place to leave their savings in digital form. Salaries, nest eggs, speculative bets on coins they barely understand. Money flows in from more than 100 countries, crossing borders in seconds and settling inside one central ledger. On paper, the exchange keeps customer assets segregated. In marketing, it says that deposits are backed 1-to-1 and safe even in a downturn. But in the background, a sister trading firm sits just across the digital hallway. The 2 entities share ownership, share executives, share a private Slack workspace. Officially, the firm is independent and operates like any other market-making company. Unofficially, it taps into the exchange's customer deposits like a line of credit. A growing share of the assets visible on its balance sheet are not dollars or widely traded coins, but the exchange's own token and illiquid instruments it created.
The first real crack appears on the 2nd of November 2022. A niche industry news outlet publishes a story about the trading firm's finances. It reports that a large portion of its assets are tied up in the exchange's own token. That token has value only as long as the exchange is trusted and solvent. The article is short, mostly numbers and ratios, but it spreads fast through group chats and trading discords. Within hours, traders on rival platforms start to sell the token in size. A major competitor publicly announces it will liquidate its entire position. Inside the exchange's headquarters, the screens start to flash. Risk dashboards show a wave of withdrawals in motion. Tens of thousands of users click the same button, withdraw. In a healthy exchange, this would trigger assets moving out of cold storage and hot wallets to satisfy demand. Here, it exposes a hole. Customer balances on the screen are larger than the liquid assets available to send out. Over months and years, billions of dollars in deposits have been routed to the trading firm, lost in speculative bets, political donations, and venture investments. The exchange is insolvent. It just has not said so yet. Investigators will later reconstruct this moment like an old-fashioned bank run. A single balance sheet leak, a competitor's tweet, and an already fragile structure begins to fall. But they do not know that on 11 November. What they see are frantic emails from lawyers requesting emergency meetings, a sudden bankruptcy filing in Delaware, and a corporate group that claims it owes customers billions while still insisting much of that value exists. The manhunt for the money starts with a simple question: where is it?
From their offices in New York, Washington, and the Bahamas, regulators and prosecutors open parallel tracks. One group focuses on legal control, securing court orders to freeze remaining assets on the exchange's known wallets and bank accounts. Another group focuses on information, gathering data dumps from internal servers, chat logs, and transaction histories. A third track looks outward, mapping every known address associated with the exchange and the trading firm across public blockchains.
Blockchain forensics teams begin their work by tagging wallets. They identify addresses known to belong to the exchange from previous public disclosures and add them to a graph. Then they follow flows, coins sent to other exchanges, to personal wallets, to decentralized protocols. Each movement leaves a timestamp and an amount. Unlike traditional banking records, much of this data is public, but it takes time to connect addresses to real-world identities. Indoors, forensic accountants pore over bank statements and internal ledgers. They find transfers labelled as loans to the trading firm, often unsecured and with no clear maturity date. They identify property purchases, luxury real estate, office spaces, and vacation homes. They see political donations routed through separate entities and think tanks funded out of corporate accounts rather than personal salaries. They trace investments in dozens of other crypto startups, from small tooling companies to large competitors. Each line item represents money that will not simply return to customers on demand.
At the same time, law enforcement begins to track the humans behind the numbers. The founder is still appearing on live interviews in November, calling the collapse a liquidity crunch and insisting that he did not intend to defraud anyone. He is physically located in a luxury compound in the Bahamas, moving between penthouse apartments and meeting rooms. Local authorities have not arrested him yet. Extradition is a long process, and the case is still forming. But international pressure is building. Agents treat him as both a subject and a potential asset. If he talks, he could help map out the internal structure. Who made decisions? Who moved specific transfers? Who signed off on loans and investments? If he stays silent or continues to do media, he could damage the case. Behind the scenes, prosecutors collect statements from former employees, executives, and compliance staff. They look for emails where concerns were raised and ignored. They look for minutes of meetings where the idea of using customer funds may have been discussed openly.
The manhunt is not just for one person. In parallel, regulators worldwide scramble to contain contagion. Other exchanges are asked to show proof of reserves, cryptographic attestations, and auditor reports verifying they hold customer deposits in full. Some comply, moving coins on-chain to demonstrate balances. Others hesitate or provide incomplete data. For investigators, this becomes a second layer of the hunt, identifying which platforms might share similar weaknesses or hidden holes. By early 2023, the case against the founder crystallizes. In a New York courtroom, prosecutors present a simple narrative. Customer deposits were taken, routed to the trading firm, used to speculate and spend, and never properly segregated. Internal records show billions missing. Witnesses describe a culture where risk limits were flexible and personal judgment overrode formal controls. Jurors hear about code changes that allowed the trading firm to carry negative balances while other users would be liquidated.
Outside the courtroom, forensic teams continue to chase the money. Bankruptcy filings detail assets the estate now controls: remaining crypto, venture stakes, cash recovered from banks. A new CEO and restructuring team work to maximize recovery, selling stakes and converting volatile coins into dollars. In mid-2024, they announced that most customers may receive back what they lost, and some could see more than 100% of their initial claim due to asset appreciation. On 28 March 2024, the founder is sentenced to 25 years in prison and ordered to repay $11 billion. For prosecutors, this is the end of one lane of the manhunt, the search for accountability. For customers, it is not the end of the financial story. Distribution plans are complex, shaped by who filed claims and how the bankruptcy court values historical losses versus current prices. But a deeper question remains unsolved. How many similar structures are still out there?
The collapse of this exchange forces regulators to draft new rules. They propose stricter segregation of customer assets, mandatory audits, and caps on related party transactions. They debate whether trading firms should be allowed to share ownership with exchanges at all. Some jurisdictions push exchanges to register as full financial institutions, subject to the same scrutiny as banks. Others take a lighter approach, focusing on disclosure. Investigators begin to treat crypto platforms less as novelty and more as complex financial infrastructure. They invest in specialized units, analysts trained to read smart contracts, follow Layer 2 transfers, and interpret on-chain governance votes. They partner with private analytics firms that maintain maps of billions of addresses. For you, the viewer, much of this world remains abstract. Numbers on a screen, charts showing token prices, headlines about billions gained and lost. But somewhere, at any given moment, there is another windowless room where analysts are staring at flows that do not line up. There is another set of circled numbers on a legal pad, another balance sheet that seems to be built on internal promises and self-referential tokens. The manhunt behind this collapse ended with a conviction and a partial recovery. The investigators in that 9th floor room can close their file and move on to the next case. But across the world, other exchanges still hold billions, sometimes under lighter oversight, sometimes backed by code few regulators fully understand. The next mystery is simple. Which balance sheet will be the next one that does not make sense?